One of the most important things that you can be doing right now is be taking everything that you hear from the Fed and the government with a little grain of salt or a pound of salt, because in one of the recent Fed interviews that I was listening to, somebody asked Jerome Powell, the chairman of the Federal Reserve Bank, how could you get inflation so wrong? How could the Fed, who is made up of some of the highest paid and the smartest Ivy League economists in the world, get inflation so dead wrong? And his answer was pretty straightforward. He said that nobody could have saw it coming. None of these economists saw this type of inflation problem coming. Now, I want to add one little caveat there, because it wasn't that nobody saw this inflation problem coming. I mean, I've been talking about this inflation problem for the last couple of years, and our subscribers all knew this inflation problem was coming. So people who were dealing in the real economy, people who go to the store and buy their groceries, who have to deal with everything going on in the economy, could predict and saw this inflation problem coming. People were feeling the effects of this a year ago. But it was the people that are making the big bucks at the Fed and these high-paid economists who did not see this inflation problem coming. Now, the reason why I bring this up is because when most people work a job and you do something so wrong, you do the worst performance that the company has ever seen, well, then typically what happens is you lose your position, or you lose your current title, or something happens, something disciplinary. That way you can be better at your position. But in this case, it works a little bit different, because after the Fed got inflation so wrong, it was known as the worst mistake by the Federal Reserve Bank ever, Jerome Powell was nominated by the presidential administration for another term, and then he was confirmed by the Senate for another term as the chairman of the Federal Reserve Bank. This is why I want you to be a little bit cautious with everything you hear, because sometimes the Fed and the government say things to keep people calm when they know that things are a big problem, because they don't want to create panic. They're trying to solve the problem behind the scenes without people worrying about it. And what you want to do is not be reactionary, but instead be proactive and start planning what you're doing with your money today. Start planning how you're going to be smarter. That way you can take better action and take better care of yourself. Because even Jerome Powell has come out and said to himself that this fight against inflation is going to be painful. Now, painful doesn't mean that he's going to get punched in the gut. Painful means that people are going to lose their money. People are going to lose their jobs. People are going to see their investment portfolio get hurt. And this is where you have to be smart and understand how can you come out of this in the best position possible financially. I think a lot of people have a general understanding of what stagflation is, but let me dive a little bit deeper, because stagflation actually involves three different things. It involves the GDP, which is the economy, the growth of the economy. It involves unemployment, up with the unump, and then you have inflation. So when you have stagflation, like we saw happen in the 1970s, you have very high inflation and potentially growing inflation. You have a slowing GDP, meaning you have a recession, an economy that's getting smaller, and then you have high unemployment. Now, it's kind of a weird concept, because you have prices of things that are very high, yet you have an economy that's shrinking, and then you have people that don't have their jobs. So it's kind of like the worst case scenario, which is why everybody was so worried about that in 2021, and they're still saying that it's not something that you have to worry about. But with everything that they've been wrong about with inflation, this is something that you should consider and just keep in the back of your mind, because if you have the price of things very high and you have a lot of layoffs and you have a slowing economy, this means that companies aren't hiring the way that they were before. Meaning if you lose your job, it's going to be tougher for you to find a new job. So you have an economy that's shrinking, you have a lot of people without jobs, and you have an expensive cost of living. The best way for you to prepare for this is really just to prepare. That means prepare financially. The second thing that you might want to consider doing right now is cutting back. Now, I know this can be a very difficult thing to do right now, especially when the prices of everything is so high. But this is really the time where you want to be able to have a little bit of cushion in your finances, because we don't really know exactly what's going to happen in the next 3 months or the next 6 months or the next year. So if you can, try to cut back as much as you can on some of your expenses. Maybe cancel some of your subscriptions, maybe don't eat out as much, and maybe don't spend so much money on luxuries and designer items. Just save that money right now, put that money into an emergency fund and have it aside just in case anything happens. I mean, if nothing happens to you, your job, or your company, well, this is some extra cash that you can use to just keep investing your money. I would also highly use this time right now to stay away from credit card debt, payday loans, and any sort of buy now, pay later, because right now we're on an interest rate growing environment, which means that all of these loans, which are variable interest rate loans, the interest rate on your loans are going up because the Fed is working to raise interest rates. Now, we've talked about this before. The Fed is raising interest rates to fight inflation. And so when the Fed raises interest rates, your credit card interest rate goes up. And so when all of these variable interest rates go up, your monthly payments start to go up. So you do not want to be racking up a credit card balance now, because a credit card balance today is going to be more expensive in 2 months and 3 months, because as interest rates go up, your monthly payments go up because the balance just gets more expensive. So if you already have credit card debt, you want to be even more aggressive to pay it down now while interest rates are lower rather than in the future, because if the Fed raises interest rates again in a month and 2 months, well, that means it's going to be even more expensive to pay it off in the future than it will be now. And the last thing that I want to mention has to do with investing your money, because when we go through these types of turbulent times in the economy, in the market, this is where you start to see a lot of panic and a lot of fear. Now, back in 2020, we saw a very unique V-shaped recovery in the stock market, where the stock market crashed very hard and then it bounced back up very quickly. I do not expect that to happen again. So what you want to be aware of is understanding how investments work, how asset classes work, and understand that if you really want to make money in any asset class, it's going to be patience that's required. That means if you see buying opportunities, buy them, because when you see a market crash, when you see a recession, that's when asset prices go on sale. You just want to make sure that you're doing your research and you're investing your money into a good investment so you can buy them when they're cheaper, but don't just expect it to turn around in 2 weeks. Don't expect it to just double your money in a month. Invest with a long-term mindset. Don't just be a trader, because the majority of traders will lose their money. Now, sure, traders can make a lot of money, especially when markets are going up or when they're very volatile, but the people who make the most money over the long term are not traders, they are investors. So look for good opportunities, and when you find them, you can buy them, buy it on the way down instead of trying to perfectly time the market, and then be patient and hold. Because now not only do you have to hold the stock, but you also have to hold your patience, because when you see the markets get hit very hard, people will panic. They'll talk about the world ending. They'll talk about the stock market ending. They'll talk about everything just completely going down. And it can make it very hard for somebody to invest. It can make it very hard for somebody to hold. But this is where you want to have the patience and the financial discipline to just tune things out. Because when you make your investments, then just hold on to it. The only thing you should be aware of is this company going to go bankrupt? Can it ride out the recession? Can it ride out whatever is going on? So that's the thing that you want to be paying attention to. And then when you see discounts, that's an opportunity for you to come in and buy. Thank you for watching. If you enjoyed the shorter clip from the longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.